Low interest rates spent a decade inflating farmland values, while hiding razor-thin operating margins. Cheap credit looked like support, but it also accelerated consolidation into fewer and larger operators. Then, central banks launched the fastest tightening cycle in a generation, and effectively doubled the cost of capital. The damage moved from farm credit lines to grain elevators, processors, grocery shelves, and currency markets in Jakarta and Ankara. This episode explains why agricultural prices react to rate hikes in ways textbooks often miss. The response is nonlinear, meaning the move down can overshoot equilibrium before any slow recovery begins. It is also asymmetric, meaning a hike hurts farm gate revenue more than an equivalent cut helps it. That timing mismatch can crush income exactly when debt service gets more expensive. In practical terms, producers are squeezed from both directions at once. The sale price of output can weaken quickly, while interest obligations reset upward on fixed payment schedules. That combination leaves little room for working capital error in businesses already operating on thin margins. Rate transmission, therefore, becomes an income timing problem, not only a price level problem. Stored grain makes the mechanism even harsher. Higher rates raise the opportunity cost of holding inventory, so producers are pushed to sell sooner. That pressure can depress spot prices further in normal stock conditions. But when inventories are already tight, small additional shocks can still trigger violent spikes despite restrictive policy. This is one reason policy signaling alone can mislead decision makers. A restrictive stance may suggest broad cooling pressure, but inventory structure can dominate the realized path. If stocks are abundant, forced selling can intensify downside moves. If stocks are thin, the same policy backdrop can coexist with abrupt upside volatility. Financial structure adds another accelerator. ETFs and commodity index funds now transmit monetary shocks into agriculture through cross-asset channels. Volatility spillovers across maize, soybeans, and the S&P 500 increasingly move together. Companies like ADM, Bunge, and Gruma are pulled into that shared risk circuit. The deepest channel, however, runs through land. In major agricultural economies, land and infrastructure represent over half of farm sector assets. Land is also the core collateral for short-term operating credit and long-term debt. When rates rise, discount rates rise, and land values come under pressure. Banks then tighten through loan-to-value constraints. Lower collateral values force stricter credit terms. Tighter credit can trigger forced liquidation, which lowers local asset prices again. That is the self-reinforcing loop at the center of the rate trap. Once this loop starts, balance sheet stress spreads faster than income stress. Asset values adjust continuously, while operating performance adjusts over seasons. Lenders respond to collateral erosion before revenue recovery is visible. Credit therefore contracts early, and recovery funding arrives late. One number captures the exposure: $400 billion of farm equity at risk from a single 1 percentage point rate increase. In the U.S. farm sector, real estate is often modeled as a perpetuity earning 6%, with duration near 17 years. Liabilities dominated by short-term operating credit sit near 1-year duration. The resulting duration gap of 13.7 leaves balance sheets highly rate-sensitive. Policy tightening from March 2022 to July 2023 made that sensitivity visible. The Federal Reserve delivered 11 hikes and pushed the target to 5.25 to 5.50%, a 23-year high. Farm interest expense became the fastest rising production cost line. In 2023, it reached $34.9 billion, up nearly $10 billion in inflation-adjusted terms in just 12 months. Short-duration debt reset quickly. Operating loan rates that were below 5% in 2021 moved above 7.7% by late 2022. The prime rate reached 8.5%. The average spread of agricultural operating notes over the 10-year constant maturity treasury was about 3.4%. That reset speed matters because operating finance is the system's daily oxygen. Input procurement, payroll, and seasonal logistics all depend on short-duration borrowing. When that channel reprices rapidly, producers lose the ability to bridge timing gaps between planting costs and harvest revenue. Cash flow volatility then rises, even before any yield shock appears. The 1980s did not repeat at full scale, but the comparison matters. Under Volcker, prime exceeded 20%, and real farm income fell from $22.8 billion in 1980 to $8.2 billion by 1983. National farmland values fell 29%, and Nebraska lost half its value. Delinquency reached 7.5% at small agricultural banks, while 68 insured commercial banks failed in 1985. Current conditions are less catastrophic, but still fragile. Conservative underwriting and diversified demand, including ethanol absorbing over a third of the corn crop, have helped prevent a full replay. The debt-to-asset ratio is near 12.78%, and the debt service ratio is 0.26 in 2024. Yet farmland purchases still produce negative cash flow when mortgage rates between 6 and 8% exceed per acre revenue. That negative carry condition is strategically important. It discourages productive renewal and favors defensive balance sheet behavior. Producers postpone expansion, lenders prioritize collateral quality, and transaction liquidity weakens in local land markets. Over time, lower turnover can make repricing episodes more abrupt when forced sales finally occur. Kansas City Federal Reserve surveys from late 2024 underscored that pressure. Repayment rates were at levels not recorded since mid-2020. Weak row crop margins were draining working capital. Borrowers were pushed toward costlier variable rate operating credit as collateral terms tightened. Grain elevators and wholesalers faced a parallel shock through inventory finance. Interest commonly represents 1/4 to 1/3 of total carrying cost. When prime reached 8.5%, carrying costs moved sharply higher. The burden was mechanical, fast, and hard to hedge for smaller operators. For the 2023 to 2024 crop year, carrying cost rose 21% on corn, 42% on soybeans, and 50% on wheat. At 4% rates, storing $6.50 corn costs about 2.1 cents per bushel per month. At 7%, that rises to 3.8 cents. Over 6 months, more than 10 cents per bushel can disappear, without any physical supply-demand change. Elevators reacted by widening basis and lowering cash bids. Farmers who stored grain on farm hoping for recovery faced a cash squeeze against variable rate debt tied to prime. Inverse future structures, where deferred contracts traded below spot, added another penalty to holding grain. Working capital optimization pressure moved upstream and compressed margins from both sides. This is the point where monetary pressure becomes a supply chain margin transfer. Merchants protect carrying risk exposure through wider basis and tighter bids. Producers then absorb lower realized prices, while financing costs remain elevated. The result is a synchronized squeeze across nodes that are all trying to reduce risk at the same time. Food processors also shifted into defense. For 2025, 31 large publicly traded food and beverage firms projected a collective capex decline of 1.1% to $19.3 billion. It was the first aggregate decline since the 2008 recession. The system started prioritizing survival over expansion. Only a quarter of manufacturers carried greenfield projects and 3-year plans. For the first time in 24 years, cost control ranked above food safety as the top manufacturing priority. About 48% redirected spending toward automation rather than added capacity. That shift protects margins now, but can restrain future supply response. At the same time, the debt maturity wall approached. Total maturities across commercial sectors are expected to rise from nearly $2 trillion in 2024 to approximately $3 trillion by 2026. High yield share rises from 15% of maturing totals in 2025 to nearly 50% by 2028. Refinancing risk, therefore, intensifies exactly when rates stay elevated. Refinancing math is already unfavorable. Current rates exceed average outstanding investment-grade coupons by 1.5 percentage points and high yield by 2 points. Research finds each extra $1 spent on interest cuts capex by 10 cents. The same extra $1 cuts labor costs by 20 cents. Those elasticities imply a long investment shadow over food systems. Debt service competes directly with maintenance, capacity upgrades, and workforce stability. Can underinvest when refinancing spreads stay elevated. The cumulative effect is slower productivity growth, exactly when resilience investments are most needed. Retail food inflation eventually slowed, but with a long lag. Aggregate price relief from contraction appears around 43 months after initial hikes. Peak reduction tends to arrive around 54 months. Monetary policy can cool inflation, but not on political or household timelines. In the data, food-at-home inflation was 1.2% in 2024 over 2023. That was down from 11.4% in 2022 and 5% in 2023. It also moved below the 20-year average of 2.7%. Relief arrived, but slowly. Market structure explains part of that stickiness. U.S. food consolidation has made core inflation 75% less responsive to food shocks than in the late 1970s. About 60% of that change is linked to increased concentration among food retailers. Rate transmission now passes through a more rigid pricing architecture. Cross-border effects are more severe for poorer economies. Households of disposable income on food versus 16% in advanced economies. A 1% food price shock in poorer countries can lift non-food prices by 0.3%. About double richer country pass-through. When the Federal Reserve tightens, capital outflows and currency depreciation magnify import inflation. Indonesia captures that exposure. By 2023, the National Food Import Bill reached $16 billion. That bill helps feed 279 million people. Exchange rate movements show the most persistent long-run influence on food security among all tracked variables. History shows policy choice is decisive, not cosmetic. Britain in the 1970s prioritized employment and used statutory wage controls under a social contract with the Trades Union Congress. Suppressed nominal wages lost purchasing power against food and energy inflation. By late 1978, the winter of discontent paralyzed core services. Waste collectors won 11% raises against a 5% government cap. Food and petrol supplies thinned, and the Labour government fell. West Germany's Bundesbank refused excess liquidity accommodation and rejected wage freezes. Japan also pivoted to stricter tightening after severe inflation and real GNP decline in the first oil shock. By 1979, Japanese real wages had adjusted more efficiently to slower productivity. Both West Germany and Japan achieved stronger long-run outcomes by anchoring expectations around price stability. The lesson was not painless policy. The lesson was credible policy. Credibility matters because expectations shape wage bargaining, contract indexing, and inventory behavior. When households and firms trust the inflation anchor, second-round effects are weaker. When credibility breaks, every contract becomes a defensive inflation hedge. That defensive behavior then raises the real cost of restoring stability. Modern cases reinforce the pattern. Sri Lanka kept a 5% inflation target on paper, while expanding liquidity in practice. When global commodity prices surged in 2021 and 2022, foreign exchange buffers were inadequate. A fertilizer ban then hit rice and tea output and amplified the crisis. By August 2022, food inflation reached 84.6%, and non-food inflation reached 57.1%. Sovereign default followed, and leadership fled. Under the 2023 Central Bank Act, CBSL independence was strengthened, with a requirement to explain target misses across 2 consecutive quarters. Institutional repair came after systemic failure. Turkey chose the opposite route at the worst time. Rates were cut during peak global inflation under direct political mandate. When the lira fell, lowest income percentiles experienced a 40% drop in consumption-to-income ratios in 2022. The burden was regressive, because food dominates poor household spending. Consumption inequality outpaced income inequality, as households were forced to prioritize basic survival. In effect, rate cuts during inflation acted like a regressive tax. Turkey then reversed course into orthodox tightening in 2024. Delayed correction raised total social cost. This sequence highlights the political economy of timing. Early discipline can be unpopular, but contains future adjustment costs. Delayed discipline can feel supportive in the short run, yet magnify distributional harm later. Food-intensive household budgets make that trade-off especially visible and socially volatile. Brazil shows a dual-track alternative. The Selic rate rose to 12.25%, and headline inflation eased from 5.1 to 4.5%. Simultaneously, Plano Safra deployed 400.59 billion reais in subsidized credit to commercial agribusiness. Tight macro policy and targeted sector support ran together. Smallholder credit under PRONAF remained capped between 0.5 and 6%, while market rates exceeded 12%. Renov Agro added environmental incentives through further rate reductions. Agriculture contributed 30% of Brazil's GDP growth in 2023. Private sector bank credit still expanded 11.5% in 2024, despite restrictive Selic. For import-dependent emerging markets, sovereign risk multiplies every channel. High baseline debt can amplify supply and demand shocks by more than 3 times versus low debt settings. Sovereign downgrades reduce the 5th percentile of future GDP growth by nearly 2.95 percentage points within 4 quarters. A hawkish Federal Reserve reaction shock can widen spreads, weaken currencies, and raise crisis probability from 3.5% to 6.6%. In that environment, policy space narrows precisely when social needs expand. Higher risk premia raise refinancing costs, while food import exposure raises welfare pressure. Governments then face a difficult sequencing problem across stabilization, protection, and investment. Missequencing can convert macro stress into political instability. Food price shocks can also become political shocks. Agricultural prices rose 70% between 2010 and 2011. Syria's uprising began in Daraa, a wheat-producing center already strained by drought. Researchers describe sustained staple spikes as a superordinate goal that can unify otherwise divided groups against the state. Forward-looking risk remains active. IMF projects global growth near 3.3% in 2026, with inflation easing from 4.1% in 2025 to 3.8% in 2026. ECB models now integrate El Niño Southern Oscillation as a direct food inflation upside risk. Fertilizer prices declined about 5% into 2025 after eased Chinese export limits. That decline does not remove structural pressure. Fertilizer costs still track natural gas sensitivity. Climate-aligned food system transformation requires about $350 billion of additional annual investment by 2030. Without that scale, volatility and adaptation gaps persist. Between December 2022 and May 2023, 178 economies launched 1,333 social protection measures, totaling $1.01 trillion. The evidence on policy quality is clear. Blanket subsidies perform worst under stress because they leak resources and distort demand. Targeting quality matters more than spending volume. Subsidy failures are well documented. UAE and Iran energy subsidies pushed consumption 50% above income-adjusted U.S. levels. Egypt's bread subsidy diverted human-grade wheat into animal feed. In Jordan, the poorest 40% received less than a quarter of fuel subsidy spending. Better calibration was possible. Several European governments cut inflation by 1 to 2 percentage points through temporary VAT reductions that helped contain wage price spirals. Reserve requirements offer another lever for emerging market central banks by restricting credit without raising nominal rates. That can limit speculative inflows tied to interest differentials. Targeted cash transfers remain the strongest long-run fiscal tool. Well-designed systems direct 50 to 75% of spending to the bottom 40%. while preserving market clearing. Structural logistics policy is equally important because cost to serve shapes food inflation directly. India's national logistics policy targets a reduction from 13 to 14% of GDP, down to 5%. The broader lesson is policy architecture, not any single instrument. Monetary policy anchors demand conditions, while fiscal design protects vulnerable consumption. Logistics and credit reforms then reduce structural cost pressure over time. Durable stability comes from combining those levers, rather than substituting one for another. 5 decades of evidence converge on one conclusion. Unorthodox growth-first shortcuts, from British wage controls in the 1970s to Turkish cuts in 2021 to Sri Lankan fertilizer bans, end in depreciation, real wage erosion, and harsher later adjustment. Orthodox tightening anchors expectations, but can choke productive food system investment if used alone. The empirically validated path is disciplined central banking, paired with subsidized rural credit, logistics reform, and targeted safety nets.